Well, if you waited for the last year when everyone's been talking about Nvidia, if you waited to buy it last week or yesterday, you still weren't too late. Nvidia closed up 7% yesterday. Just an incredible run. I don't know how we start the show other than just talking about Nvidia right now. It is truly Nvidia against the world. Might be a crowded trade. We're going to talk about that with Dennis this morning. Some other headlines we're going to get to. American Airlines guides down. Bring some airline stocks lower. You have Robinhood doing a buyback. Some merger and acquisition news in the oil and the gas and oil space. So we got a lot to talk about this morning. Let's go ahead and start pre-market prep. Welcome to Benzinga's pre-market prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
Alrighty, guys, we're trading a little bit lower this morning as we head into the open. Yields have risen again for the second day in a row. Let me go ahead and get my Benzinga Pro pulled up, and we'll run through the indices before we bring on my man Dennis Dick, who hopefully is well rested today because the Oilers did not play last night. That doesn't mean there wasn't any thrilling hockey. You had overtime in the Rangers-Panthers series, I believe. What happened? The Rangers tied it up 2-2. All right, let's go ahead and share. Is that what happened, Dennis?
I popped on. It actually was Florida. Yeah, Florida tied it up 2-2.
Oh, Florida ended up winning in overtime?
Yeah, they did. Yeah.
Okay.
So that series is 2-2, and it's funny. It bodes well for the Oilers series because the Oilers have been following Florida's lead here. Florida's always played the night before, and whatever Florida does, Edmonton does. So we're hoping the same. Florida won
to tie it up.
They lost, and they lost, and they won. So Edmonton's won, lost. We're hoping for a win tonight, but you're playing some sports there, AB. Let's get the sports talk out of the way here. You hit it on a parlay again here. Tell us the story, AB.
Yeah, real quick before we get to that, I'll just go to the indices because I didn't have my Benzinga Pro pulled up, so we know what's going on. SPY trading down 0.5%. You got the Qs trading down a little bit more than that, 0.63, and the Dow, which was your laggard yesterday, trading down 0.5% as well. All right, let's get the sports talk out of the way. So I was telling Dennis before we hopped on. So, and I was, moonlighting in a restaurant, which I'm not really doing anymore. It was just kind of too much. I didn't like having 0 days off, and they wanted me to work every weekend day. So I told them, you know what? No, I'm going to enjoy my summer. But I still had some cash laying around my place, and this was all small bills. Like I had $200 in ones. I looked like I worked at, like a strip club or something. But I was like, I don't know what to do with all these ones. Like, I guess I could go to the bank, but that's kind of boring. I was like, who will take my ones is the casino. So I went to the casino after work yesterday with $200 in ones, exchanged them at the thing for $200 bills, played a few hands of blackjack and wasn't going well. And I was like, you know what? I'll throw this on some sports bets. So I just made some parlays, $25 to win, $5,000, this and that. But I had one that did well. Let me see if I can pull up
can you show it?
A picture of it. Yes. Let me try to, here we go.
You're going to retire from stocks trading and just be a professional gambler on Sports Gambler. I can just tell where this is going here. You look awesome at it.
I mean, here we go.
Let's see this parlay.
I do it. It works. When it works out well. The problem is that I'll oftentimes take my sports winnings and lose them in the, so the shadow here isn't doing great. So it was the Red Sox, Cubs, Twins, Rangers, Angels, and the Yankees and Angels under $50 to win $8,000. And all the early games had hit. You see my little check marks up there, and then the Angels and Yankees were playing, and the Angels were losing 3-2. So I needed them not only to come back and win the game, but I needed it to stay under 8.5 runs. So the only way I would have won that bet is if the Angels come back and won by either 4-3 or 5-3. Bottom of the 8th inning, they're down a run. They score 2 runs to make it 4-3. I was watching the top of the 9th. All I needed was 3 outs, Dennis. I thought for sure they were going to let up a run. Something was going to happen, and I was going to end up losing that bet. But the closer for the Angels went 1-2-3.
Oh my God.
That bet.
You bet $50. Show that again, though. You bet $50 and won $7,000 last night. $8,000.
That's what, like
$8,000.
that's a 40x or
Holy crap, AB. Retire from stocks. You're a professional gambler now. That's a crazy win, man. $50, 40 times. This guy, like.
No, that's more than 40. Wait,
You
is
know,
it? No, I don't know. I can't do the math right
50,
now.
40. I don't know. It's a
No,
lot.
it's more than that. I think that's like 150. I don't know. Either way, it was
we don't even know how to do the math. It's
100,
too much. It's 8,000 divided by 50. What the hell is that?
Yeah, because 100 would be 5,000. 100 to 1 would
Holy
be 50
crap!
to win.
8,000 divided by 50. You just literally 160 times your money. 160 times your money.
But again,
I've never had a stock that I've 160 times my money. I think I'm just going to stop trading and just listen to AB and become a professional sports gambler too here. This is crazy bet. 160 times your mony. Holy
again,
crap,
it doesn't usually work out like
those are your tips. Your $1 tips. You take to the casino. He cashes them in, gets two $100 bills, and then bets it all on how many baseball games? 6?
It was 6 legs, 5 games total because I did 2 legs in the Angels-Yankees one. But yeah, I mean, it usually doesn't work out that way, and I don't want to just come off as like, oh, like bragging about look at how much money I made. But it was just
awesome.
It was just a funny.
I would brag about that. That's awesome.
It was just a funny story because I was like, I fully intended on just going to the casino and losing that $200 because I was just sitting in my room. I didn't care about it. But all right, let's get back.
You care about it now. That's significant. Go buy some shares of Nvidia with it.
Yeah, well, I already placed two new parlays for tonight, so we'll see.
Oh, that's going right back in. Okay.
Yeah. All right, let's get to the headline. So I mentioned Nvidia on the hop, and I mean, I don't know how we start this show talking about anything else. Yesterday closed up 7%, almost $75, and like the point I was trying to make in the intro was because if I had a friend or someone, Dennis, who came to me and said, "Hey, everyone's been talking about Nvidia. I want to buy the stock," I would have been like. I don't know. I would wait for it to pull back. You're kind of late here. Everyone's been talking about it for the last year. But if they did that last week, then boom, you're instantly rewarded. I mean, how many times do you buy a stock and you're up 7% on it in a week? And that's what would have happened if you bought Nvidia at the end of last week.
You're up more than that, 7%. You're up 7% in a day. It was up 7% yesterday. You literally bought this 4 days ago. Saying, well, I think the earnings are going to be good. It was the gap and go earnings. You bought this into earnings. It closed at $950. In 3 sessions, it is up 20% almost 20% in 3 sessions since the earnings report. It got the 7-8% pop. Then it had the 1 day consolidation. Then it just popped another 7-8%. It's up here again. I mean, this stock, the beat goes on, whatever you want to say, Nvidia versus the world. I'm looking at my filters. I'm looking at my portfolio. Everything is down. I mean, you might have got lucky and had Marathon Petroleum. I did not have that in my long-term portfolio, but every stock is down today. Apple's actually green. But Nvidia, I mean, there's probably like 90% of stocks are down today. Nvidia does not care, continues to go higher. This pre-split run is incredible. We've talked about this strategy too. Owning stocks, head of the splits. We talked about it yesterday. Man, that strategy paying the bills.
Yeah, and the one thing I'll say, so I have a little bit of money in like a managed account at Morgan Stanley. It's actually my one of my really good friends' dad who's like the wealth manager. He does a really good job. But one thing I've noticed that he'll do is he'll buy stocks after a great report. And he didn't here with Nvidia. We've already had some Nvidia in the portfolio because trust me, I've made sure of that. I wasn't going to have no Nvidia in the portfolio. But I wonder if there's some of that going on where maybe some, like institutional investors, people that manage money for other people have heard their clients saying they want Nvidia, saying, oh no, we're going to wait. And then they report that and they say, okay, you know what? No, the company is doing really well. We can buy it here. So again, I'm not saying that's exactly what's happening here, but I have noticed that that the wealth manager that's managing my portfolio will go in and buy a stock even after it's up, say 10, 15, 20% after a great report. Because I guess the data shows that those companies tend to continue to move higher after that move, after the report.
You listen to the show so you don't need a wealth manager. We just listen to the show so we manage our own wealth here, AB. But I mean, it's this honestly running is, sometimes you get the gap and go on the earnings and sometimes you see that. But when they announced a 10-for-1 stock split, there was a good probability this was going to continue to show strength. People buy ahead of the splits. It's just a fact. CMG was the same thing. They bought, again, the earnings, but they bought it up on that. It held for about a week or two, and then, it continued because of the earnings. But I mean, owning stocks ahead of splits just works. Again, the strategy is own them ahead and sell it the day of the split, because usually they open up the next morning because everybody's so excited to buy it, and then you have basically buyer exhaustion, and then they usually come in. So if I was to say which day Nvidia would top out on, from a statistic standpoint, may not be the case, but from a statistic standpoint, I would think that it's going to be the morning of the split, of the actual split. And what's that date? Is it June 6th or June 7th? I keep forgetting. Do we know that? June 6th? Jack can help me out.
What day does Nvidia split? And so to your point, DJK in the chat.
Ask ChatGPT. Oh, they don't have that information.
Was saying it too. I think ChatGPT 4 now has like real time.
Has new information now?
Yeah.
ChatGPT.
I think
Hey,
so.
Siri. Let's see how good Apple is. Hey, Siri. What day does Nvidia split?
June 10th, I'm seeing.
Okay, well, it found me a site, but it would have been nice if it would just.
Someone's saying June 7th. I'm seeing. Hold on.
I'm trying to find it too. The 10-for-1 stock split. Okay, so holders of this stock have to be holding June 6th will receive 9 extra shares. It will, for each shares they hold after the close on June the 7th, with split adjusted trading to begin on Monday, June the 10th.
Okay, so the split will
June
actually.
7th, and then Monday, June the 10th is when split adjusted trading begins.
Got it. So DJK in the chat was saying too, it's retail buying for the split, and I that is 100% happening.
Oh yeah, for sure.
But my point was, like, I don't think retail buyers alone are enough to put. I mean, what's Nvidia's market cap? 2.8 trillion now, pushing up that stock 7% yesterday. Like, you had to have some institutional.
There are hedge funds buying too. Like the stats that I'm throwing out there. There is alpha to extract from owning stocks ahead. I guarantee you, there are hedge funds that bought this thing on that news and saying, "Look, it's soon. There's going to be a positive move higher here." And they're smart, man. They're smart to be doing that. I still hold my core Nvidia position from, the 7 or 8 months ago that I bought it, or 6 months ago. I bought it when I bought it at 410. I still hold the extra shares that I bought at 520. Then I had bought more at 600 and I had sold those. So I still have a pretty good chunk position. I trade it every once in a while too. But I mean, at this point in time, like you said, if you're sticking this in your long-term portfolio, at this point in time, you are chasing it. There's no doubt about it. I mean, could it continue? Could it become, the most valuable company in the world? And I think it would around. I think I did that calculation last week, and I forget. I think it was like $12.50. If Nvidia hits like $1,250, it actually passes Microsoft market cap, which would be nothing short of incredible. I mean, it could happen. It could happen on this run. We just watched it go 200 points in 3 days. It could go another 100. I don't know if it's going to do that. It feels like this is like a big move here, and a lot of good news is priced in. But man, it has got all the momentum right now. S&P's down, Q's down, every tech's down, a stock down except Apple pretty much. And Nvidia just has none of it and is up another 8-9 points here again. I mean, at a certain point in time, the trade's going to be crowded and there's going to be a really ugly day in here. I don't know if that happens pre-split or not, but I know from the stats, owning stocks ahead of splits does do well usually.
Yeah, and so a couple things, and before we get to other stock headlines, because I think this is a good conversation. So, we talked about my bet. Like, obviously, that's, fun, great and stuff. But one thing I've learned over the past few years, so I sold 8 shares of Nvidia out of my like Roth IRA or one of my like long-term investment accounts at like $350, not because I wanted to, but because I needed to like pull some cash out. Yeah. And that's really made me realize, like, I need to do whatever I can in like my personal finances.
To not pull the cash out of your long-term
exactly investment. To not pull money out of my investment accounts, because like that's just what happens is like you sell the stocks because you need money, and the next thing you know, a year later, you're looking at it being like, wow, that $3,000 that I had to pull out to pay my credit card bills or whatever would be worth $10,000 now. Not only would it be worth $10,000 now, but I'd have 80 shares of Nvidia in less than a month. And now I don't have, any in that account. Luckily, I still have exposure to Nvidia, other ways. But You know, again, like that's just something I've learned through my own personal journey, is that like, you know, being able to manage my finances to a point where I don't have to access the, you know, what's in those accounts, I think is crucial, especially if you're, you know, planning on holding those shares for 20 plus years like I was. So again, that's just like something I've learned.
This is an important conversation too, even if you don't, you know, need to pull the money out. You know, I struggle with this as well, is try not to trade your long-term investments. You know, like the worst thing that I've done is, you know, taking those gains, you know, and I look back at the stocks that I owned, you know, over the course of the last 22 years, and I've taken gains on a lot of them over the years, and you get up 100, 200%, you think, you know, I've got the bulk of the gains and, you know, it's not going to continue. And then they just do. I mean, I can remember I owned Home Depot at $30 a share and I sold it at like 70. It's 328. I owned Lilly at $30 a share and I sold it at like, I don't know, 200 or 300, 200, I think it was, or something like that. And it was an awesome gainer. It's 800. I owned MasterCard at $11 a share. I sold it just last year. I think it was 350. It's 450. I did good on that one. But I mean, the worst thing you can really do is start trading your long-term investments. Have them in separate accounts and try not to look at them. So in the long term, buy good companies at reasonable valuations and try not to look at them. Even Nvidia, you know, I bought it multiple times. I bought it 3 times in the long-term account. Yes, I kept the original core position, but I mean, I had bought it 2 more times and I sold it a couple times there too. SMCI, I sold out of all of that. That actually, well, that's kind of actually where I sold it. Was, well, actually my original sell I think was like 600 or 650, and then I sold more at like 950. But I mean, the worst thing you can do is just start trading out of your long-term investments. Have a trading account where you're doing strategies that we talk about, owning stocks ahead of reports, you know, whatever, you know, technicals they use. Joel used a lot of technicals, but have a long-term investment account where you're buying good companies at reasonable valuations. Nvidia, though, if you're coming in now, to your point, you're a little late to the party.
Well, I think so too, but if the price action keeps
keep going, I know.
Yeah.
Maybe it's gonna go up another $100 today, so maybe we're not. People are asking me, you know, when are you selling your Nvidia? When are you selling your Nvidia? I don't know. I'm in from 400. I think about $410. I still think Nvidia. If you envision, and sometimes it's got to take a step back and envision where AI is going. It is going to be everywhere. Everything we do, you know, like to driving your car, which Tesla's going to be a big part of, but Nvidia will be a part of that too. To, you know, having humanoids, to like answering all your questions, you know, which we already have to a certain extent, but that's going to continue to improve, to just everything, to functionality, to understand the customers better, to like customer service. AI is just going to be everywhere. So if Nvidia is going to be the big part of all of that, why not own that company into that? And I mean, again, people say, well, it's all pull forward. These are cyclical businesses. This is not going to continue to have these gross margins that it has because competition is going to come in. All true, but the one consideration, folks, is that the bubble, the pie is going to grow exponentially. So even if those margins come in, and even if you have pull forward, this pie is going to get so much bigger, this AI pie, that even if Nvidia loses half of their market share to AMD or to Microsoft or Apple or other competitors, that pie is going to be so much bigger that it's hard to envision like this company just falling off a cliff and going back down to $300 a share. I don't see it happening. The only way, you know, if we get Taiwan invasion or something like that could happen. But sometimes just sit back, look at the big picture with your long-term investments, and own companies that are at the core of movements. This AI movement is for real. It's not a fad. It's happening. It's going to happen. Nvidia is going to be a huge part of that.
And I mean, I love Nvidia, and I still, if I, you know, still would be my favorite stock to hold long term. That would be my one concern in the near term, is that all these tech companies are, you know, buying their GPUs from Nvidia, bolstering their technology for this AI boom, maybe getting out ahead a little bit of before the AI technology actually is like there to use all of it. So they're like all prepared for it, but then we're still waiting kind of for AI to develop, which is developing rapidly. The other side of that is I think you still have probably a year or so of strong demand for Nvidia's products. And in that year, you're just going to see AI continue to develop rapidly in all these new use cases, whether it be for Meta or for Google or for Apple. All these new use cases will continue to develop for AI, and that will help then drive further demand in the future. But what was that when I brought up that point the other day that maybe all these companies are getting out ahead of it right now and buying what they need, and then they're not going to need as much later? You had like a word for that effect, right? Maybe not. Maybe it wasn't you.
Say it again.
So like if all of Nvidia's customers, like your Googles, your Metas of the world, buy all their Nvidia products they need right now, and then later down the road, a pull forward demand. Yeah. Okay. So I think there's a slight risk of that, but then like I said, I think on the back end of that, you'd have AI technologies that are being developed that then drive demand further in the long run. But in the short term, you could see some of that. All right. It's been 20 minutes.
And again, and just continuing with the AI talk, and I know we'll move on here in a second, but like, I think this is a natural move into Tesla here. And, I wanted to talk Tesla. We got to get Joel, back, because Joel's of the opposite opinion. Joel, thinks that Tesla's going down, even though his wife owns shares. He bets against his wife's book all the time. But I think, like, people think this AI, and Boris is saying it in the chat, and it's a good point. It's futuristic thinking. This is out there. This isn't happening today. I don't think it's out as far as, we think it is. Like the self-driving, people are saying we're 15 to 20 years away from self-driving. There's a lot of people that really think it's that far out. I don't think it's that far out at all. Waymo's already doing it in San Francisco. Yes, they're bounded by, just in San Francisco. So they've mapped out one city, and they've got to kind of figure it out. I don't think it's that far away. I think we're going to see robo-taxis in the next 2 years. I don't know if it's going to hit, like Elon's saying, by the end of the year. We know Elon's targets are always, a little bit more optimistic. But within the next 2 years, probably going to happen. Robo-taxis, where you actually, the car shows up with no driver and drives you to your destination. I'm calling it right now. Within 2 years, you're going to start seeing this around the world. We already have it in San Francisco and 3 other cities in the U.S. You're going to start seeing this more and more and more. So you think about Tesla, and I keep coming back, and I own a core position in Tesla in the long-term portfolio, and you see it at 50 times earnings, and you say, well, the core business, and Joel makes some fantastic points on Twitter. Core business is struggling here. People aren't buying the cars like they were, so that's a problem. You're buying a car company, and the cars aren't selling that well. That's a major problem. But when you just take those blinders off and you see Tesla, and we've argued, on this show, when I first started the show 10 years ago, I argued Tesla's a car company. It is a car company, but it is now an AI company. There is going to be a lot of different revenue streams coming for Tesla. So, I mean, you look at this and you think like Tesla could have an Nvidia moment here eventually. It really could. Not saying it's coming tomorrow. Not saying it's coming next week, but I don't know when it's coming. The timing on this one's really tough, folks. I just know I want to hold some shares of Tesla because I think eventually, and it's always a guessing game, you never know anything, but I kind of feel the same way about Tesla that I did about Nvidia, that I'm like, they are going to be a big part of AI. And you're paying a premium multiple. I would love Tesla on $100. Come down to 30 times earnings, back up the truck, it would be the biggest position in my long-term portfolio. I don't think it's going to get there. And the reason it doesn't go down on really bad sales, and in April, the report wasn't great, but it bounced up on it. The reason the stock is not going down when the news flow has been that great is there are investors that are seeing the forest through the trees, where there is so many other revenue sources coming for this company. They're going to be taking market share from Uber like nobody's business here eventually. They're going to be coming in with the humanoids. That's coming. That's $1 trillion industry potential. I mean, there is stuff coming for Tesla. So you're paying 45 to 50 times earnings. It's not a cheap stock, but it can grow into that multiple. That's what I'm arguing.
Yeah, I mean, the thing that's concerning for me for Tesla right now is you see the forward PE is 70, the current PE is 45, and that's because the earnings
are not, they're going down.
Have been decreasing. Yeah, if you go here,
really bad. That's really bad news.
In Benzinga Pro, in our income statement, you can see total revenue. I mean, a quarter ago it was 2.5 billion, then it was 2.1 billion. Or maybe that's 25 billion to 21 billion. So you're seeing the quarter over quarter drop in revenue, which just scare me right now. But to your point, you're not looking at it as like how much revenue is the company making right now? How much revenue will the company make once this self-driving is operational? I'll say just on the self-driving front, I 100% agree. Like, it's there. I think the technology is already there. I
It's
think
there.
other companies already have the technology too. I think just from a regulatory standpoint, you
That'll
are
take
gonna
time.
you are gonna see it take a while to. I mean, because just think about like even if all the big auto manufacturers, Toyota, GM, Tesla, all had this ready to go right now, like how long will it take the government to start that transition from like, okay, instead of it just being available in Phoenix and San Francisco, other cities are state by state going to start legalizing it on their highways? Is the federal,
Yeah.
like the
So you
I don't
can't drive across states because it's not legal in this state. So
right.
there are issues for sure, state by state.
And I think like it'll just I think both from the company standpoint, from the private sector, and from the government standpoint, they're gonna be cautious and slow with it because they don't want to, okay this, and then next thing you know, like day one, you get
Car
some
runs over
family
a kid.
in a minivan that crashed, and then some lawmaker has to respond to like, hey, even though, and people will freak out about it because even if they say there are less crashes, which that's the whole goal of this, people will pull those news stories and say, look at this, self-driving this, even again, if it's fewer crashes than what would have been humans driving. So I think it will take a while for like the mass adoption, but I think it's going to be
It's coming.
it's
And
coming.
Joel's argued that nobody wants this. Also, Ricky Bobby in the chat asking, is there demand for full self-drive? Do people want this? What's going to happen is some people are going to start getting it and they're going to be like, that is awesome. I love the idea of just sitting back in the back of my car and going for a long road trip and doing work and having a nap and not even having to be in the driver's seat. Now that's a regulatory issue, but just imagine.
All right, no naps.
Imagine all that.
No naps.
No naps. But imagine all. But you can in the Waymo. You can go in the back of that seat and close your eyes and relax. It's already there, folks. Like the technology is there, so there will be demand for this. But the regulatory hurdles that AB is talking about are probably the biggest hurdles. So those are your
wait.
and
Also,
yep.
Go ahead. Sorry.
And then the humanoids. I was going to change the subject, so just finish your point.
I was gonna say the insurance companies. You know what they're gonna do? They're gonna lobby. They're gonna lobby against it because there's gonna be so many fewer crashes. They're gonna make less money. So all your Progressives, Geicos of the world are gonna
imagine that.
They're gonna lobby. They're gonna pay money to politicians to basically say like, no, don't let this happen because it'll be terrible for those businesses.
When we get to a point 5 to 10 years, it is going to be safer. It's going to be safer driving out there. There's going to be a lot of
100%.
A lot less crashes. I really believe
a lot less traffic too.
Yeah, it's going to be more efficient. Like you summon your vehicle and then you do in ride shares, and there's so many different things. The world is going to change, folks. Here, this is as big, or if not bigger, than the internet. And that's why I want to hold a core position in Tesla and Nvidia. The timing of it's going to be tough. And Tesla's going to go down. They're going to have a bad report. It's going to go down to $160, $150. And people are going to just come at me on Twitter so hard and saying, see, Dennis, you're an idiot. You're wrong. But I'm going to tell them back. If you are not on margin and you're not buying it with options, you're just sticking shares in your long-term portfolio. You don't have to get the timing right. You can just be long. And you know what? If you're right 10 years from now, you're going to make money. So write this down, folks. As a trader, it's all about timing. As an investor, it's all about basically the time in the market. But its timing doesn't matter as much. You don't have to get it perfect. You got some cash. It's not costing you anything to hold that stock. Opportunity cost maybe. But I don't know when the stock blasts off. But I think at some point in time, Tesla has its Nvidia. Its Nvidia move. And that might be next week. That might be 2 years from now. But I think it's coming, and I'm willing to wait. So Tesla, no trade. It's not in my trading account, not even touched. I may day trade it or something like that. But there's no like, oh yeah, I think it's setting up. Wow, this is a swing trade. I might do that. I don't think that's the case right now. I just think I want to have some core shares in my long-term portfolio. I wish my whole portfolio, and this is a good segue into the other stocks. I wish my whole portfolio was just AI and technology. Because you want to know what the shitty stocks are in my portfolio? I've got these value stocks, AB. These value stocks, these legacy value stocks that are all complete crap. If I had just, Nvidia, an AMD, the SMCI, the Tesla hasn't gone yet, but I mean, just focusing on those. But let's go to American Airlines. Yeah. Because here's your crap value stocks. Crap. I bought this at $15 because it's trading 10 times earnings. And how can you go wrong? You know how you can go wrong? When they start cutting guidance. So here they were, firing on all cylinders through, the last 2 years, and everybody's traveling and the stock goes nowhere. Now all of a sudden you're getting a slowdown and people aren't traveling. They're a little bit tighter. Pennies, they're pinching their pennies a little bit more. And American Airlines warns you last night about earnings. And look, boom, boom. It's like, why do I own this piece of crap stock? That's what I'm asking myself.
Yeah, so so American Airlines came in last night and lowered guidance, reduced revenue outlook. Obviously, never a good sign. Market got spooked, traded down more than 8% after hours yesterday, now down 9% pre-market this morning. This is after the stock closed down nearly 3% yesterday. So you're looking at like a 12% haircut here on American Airlines as we head into the open. Bringing down other names in the airline space as well. You look at Southwest down 3.5%. You look at Delta Airlines down about 3%. What are other ones? Save, Spirit's down a little bit. So it wasn't. Did they say specifically the company about consumers spending less? Because I didn't know if it was from that or from like I guess they said revenue. The revenue guided down, which just for
spending less.
Yeah, for revenue to go down for an airline company, that means people are buying less airline tickets. But if they said something like that we were spending more money and oil's higher, so jet fuel is going to be more expensive, all this stuff. Because I don't know, I've traveled a couple times in the past month, and the airports have still been pretty packed. I think the TSA over Memorial Day weekend did its highest. I want to say like broke its post-COVID record over Memorial Day weekend. So kind of I'm seeing some conflicting data in the travel space, but I've long said while we've been waiting and we thought the recession was coming 2 years ago, it never came. We thought it was coming a year and a half ago, it didn't come. I've long said that I think travel and leisure will be your canary in the coal mine, because as people pull back on spending, that's like the easiest area to cut back on, saying, we don't need to take that weekend trip.
It's the dangerous area. I'm with you. Like that's where, and again, the American Airlines position, I actually did sell half of it when it went from, I bought like 15 and went down, and then it came back up and I actually sold half of it. I wish I would have sold the whole thing though. But I mean, you're absolutely right here, AB. This is where people cut spending first, is, like when they start to get tough. And I think we are. I think you're seeing it. You've seen a slowdown in Canada. Like the Canadian slowdown is there. It's been there. But again, we've talked about this because that's mortgage related. We don't have, people with 30-year fixed mortgages. They all have 5-year fixed. And as they have to continue to renew, they're seeing, less people spend money. But I think that's happening, everywhere here to a certain extent. You're seeing a little bit pockets of slowdown. It's not in AI and it's not in technology. And that's maybe why the separation. This might be a good conversation for the overall market. Like, why does IWM not participate? Is it the fact that, it's not AI and everybody just wants AI? Or is it the fact that a lot of the companies in the IWM are very dependent on interest rates and interest rate sensitives, and interest rates are not going down anytime soon, it doesn't look like. And maybe the consumers are just a little bit more strapped, and the companies that, people are spending money on that are in the IWM, they're spending a little bit less. So it's just maybe, not, the place to be. Like IWM, we look at how good this year's been for stocks, but the IWM is basically flat on the year. We're up slightly. We're up slightly, but not up nearly what the Qs are and the SPY's up.
Yeah, and I think, it's hard for people to change their consumption habits. So I think what happens is you start, when you do kind of have a pullback, you don't see those consumption habits shift right away. I think people start, spending more on their credit card or this or that. And then once it hits a point where they're like, oh shit, now I've got, my credit card almost maxed out. Now I really have to cut back. So I think that it gets pushed back a little bit, that cutback in spending. And the thing is though, to me, like if we are seeing that right now, I think you'll see it pretty quickly. And when I say that, I mean in the span of about like 3 months in data. And, leisure companies and travel companies and hospitality and restaurants will start hiring a little bit less, and you'll see it in unemployment. And then we're talking about rate cuts again. So I think like there's always on the back end there something you could look forward to. And I mean, the yields going up higher today. CME Watch tool now showing. I'll pull it up real quick on my on here. We'll look at it.
And why the sell off yesterday in so many stocks? TLT, the sell off again.
Oil.
I mean,
oil prices,
rates going higher. This is the canary in the coal mine, AB. This is the issue, is that AI doesn't care about rates, but there are a lot of companies that absolutely do. And the TLT going down here again today, you're asking reasons why the stocks are down here today. well, yeah, China got hit. We're having, they were marching or something, and they're worried about Taiwan situation. But really, it's interest rate sensitive here. So show this tool, and then we're going to bring Greg into this conversation here. Actually, we should just bring Greg into this conversation right now because it's just a good conversation for Greg to talk about too.
Yeah, let's go ahead and give
Greg, and then we can talk about the interest rates.
All right, yeah, I just had one point I was going to make about this, but I'll make it with Greg on the show. Let's go ahead and give Greg our special pre-market prep welcome. All right, GregWeldon, welcome back to pre-market prep. How you doing this morning?
I'm doing great. How about you guys?
Good. Lot to digest this morning. So the one thing this is the CME Watch tool. It's showing us the probability of where interest rates will be. This is for the September 18th meeting. It's my sister's birthday, actually. It's showing a 41% chance that we will have a quarter cut at that meeting. I would actually be willing to take a bet that it is going to be in this camp that they're saying is 41%. And the reason is because we are starting to see some of the pullbacks in the economy. I mean, the unemployment rate has inched higher here, gone from 3.4% up to 3.9%. And I think we're going to be at a point where the Fed will feel comfortable cutting rates by there. And guess what? If I'm wrong and we're staying here at 525 to 550, it's because the economy has stayed pretty strong, and that should be good for stocks too. So I think, again, I'd be willing to bet here that we're going to drop here. Greg, what do you think?
Yeah, I think that, if you look at what's happening, everyone's talking about how strong the consumer is at the beginning of the year. And, while there was resilience on behalf of the consumer, you have seen erosion in the labor market. Most of the jobs being created are part-time. You see number of people working 2 jobs that are full-time is above a level that in the past has almost always led to recession.
How does that work? How do you have time to work 2 full-time jobs?
Hey, you got to do what you got to do to make ends meet. You borrow on your credit cards and you work 2 full-time jobs if you have to. This is the stress the consumer is under right now.
Yeah.
If you look at the data in the last 60 days, and we had this discussion last time I was on, that the consumer data has really eroded here significantly. You saw the consumer confidence numbers, but what we saw from the Fed was that consumers expect to cut back spending. All right, at least the growth in spending will be less because they're stressed out and maxed on their credit cards. And you see the delinquency rates, the transition into newly delinquent and especially transition into seriously delinquent beyond 90 days on credit cards and auto loans is rising at a pace and is at levels that we haven't seen since 2007, 2008. So from that perspective, the consumer has borrowed to maintain while wages have been flat to negative on a real basis. Retail sales, the most recent retail sales numbers, there was a $24 billion gain in retail sales, right? But 27 billion of it could be ascribed to price increases. So people actually paid more to buy less stuff. And now you see even the latest survey that I really liked came across this week. The 78% of consumers now say that eating out at a fast food restaurant, which averages for a meal of 4 people $70, is now considered a luxury item.
Yeah.
So the consumer is getting whacked here. And while the market has rallied, we know the breadth has been very narrow. We know that 4 stocks have been responsible for over half of the gain in the year-to-date S&P 500. And when you look at the consumer stocks and the XLY, they're back to pandemic lows. So I think that, yes, there will be a transition in the narrative from fighting inflation to protecting the economy. And I think you're pretty close to that. And I think the Fed needed to work Fed funds back higher because they also didn't want to be seen easing when stocks are near record highs and gold's rallying through $2,000 like there's no tomorrow.
Bitcoin's at 70,000.
Yeah. So, yeah, exactly. So I think there's actually some level of thought, I believe, inside the Fed that the ultimate victory on inflation would be if asset prices came down, particularly in equities. That would kind of seal the deal, and then they could ease. So I think the question is, do you need a sell-off in stocks first to be the final kind of nail in the coffin that the Fed can declare victory on inflation or not?
And you get data like from American Airlines last night. I don't think it's getting enough media attention, though. They're significantly lowering revenue. The airlines have been going and flying for, the pun kind of intended there. And, consumers are traveling still. They still have a lot of money. They wouldn't be traveling if they didn't have any money. Well, all of a sudden, you got American Airlines cutting guidance, and you're like, well, the consumer is maybe thinking second, about that extra trip. And now you see all the airlines down on American Airlines because they're like, oh my gosh, what if this, and UAL funny came out and UAL said, no, we're okay, but they're still hitting that stock because they don't believe it. I mean, then you naturally think about the cruise lines. Well, if they're not flying as much, well, maybe they're not going to cruise as much. Now you start thinking about the hotels and the casinos. You start thinking, well, travel starts going downhill. Consumers start getting stretched. Is this the start? Because that's probably the first thing you cut out. Is this the start of the consumer actually curtailing their spending?
Yes. What's going down too, if you nailed it on the head there, man. Really good call. Because it is, you look at Wynn, MGM, Caesars, all getting whacked and breaking uptrends too. And how about you talk about anecdotal evidence? This is the worst Memorial Day movie theater attendance since the early 90s. So now the movies were pretty bad, so maybe that's part of it. But less, you're talking about a consumer that is cocooning. And that's exactly what we said, that there would be a choke point and the consumer would begin to cocoon. You see it in discretionary spending for sure, in the retail sales. All those sectors are down on a year-over-year basis, dollar for dollar. So, and when you look at the XLY versus the S&P, it's always the leader. That ratio spread is so accurate and so much an early warning sign for both peaks and for lows. It bottomed first in 2009 before the St. Patty's Day monetary massacre lifted everything with QE. So, yeah, I think the consumer is in the crosshairs here. And I think what's interesting to me, too, to kind of shift the focus a little bit, is that even though you have Nvidia really performing and Broadcom's almost at new highs, and a lot of these stocks are performing well, the XLK is not like running off to the races. No. And on the basis, it's kind of lagging a little bit. So to me, that's a sign too. What's performing is the stuff we talked about last time I was on. Utilities, materials, the defensive stocks. So you've seen a rotation too in the allocations away from some of the high flying. Let's take a profit here and park it somewhere defensive just in case the consumer does choke and the Fed waits to see that reflected in the equity market before they come to the rescue.
Greg, I mean, I know you're a big commodities guy too. I wanted to talk to you a little bit about oil here. Crude prices, I think, hit their 2-month high yesterday, reached $80 a barrel. I mean, if we're talking about a wider pullback in spending, and maybe some economic weakness, wouldn't oil prices come down a little bit? Why are we seeing them actually come higher here?
Yeah, you might think, and that might still happen, but the bottom line here is that it's still a supply side market. All right, you can tell that by looking at the calendar spreads, the swaps. They're still in backwardation. They're still concerned about getting enough physical crude oil to market to meet demand. I mean, Cushing, the Cushing deficit, which is where they deliver the WTI crude oil, so that's what really drives the New York swap rates. You've seen, some build in inventories, but you're kind of in an inventory build period where you're kind of not keeping pace. And I think when you look at the technicals here, crude oil had a beautiful, textbook, technical analysis 101 book, ABC, Fibonacci correction to the moving averages, the 200-day exponential moving average, and is breaking out now. And I think a correction in energy might be over here. And we bought crude oil for our money management accounts yesterday. So, yeah, you're spot on.
What other, moves are you seeing in the commodities world that you find interesting that could maybe give us some inklings or clues into the market right now?
Yeah, there's a lot of them. I mean, as we know, China has been really such a major player. They've been accumulating a lot of these commodities, and more so more recently as they are dumping bonds and buying gold specifically. And that there's a lot behind that speaks ill of the dollar longer term. That sets up, when you bring the Fed into play, a 1-2 punch to the dollar that could knock it for a beautiful for the commodities markets. And I think that's one thing that holds the Fed back. And it's like, we can be patient here, because when we do move, you will see the next round of inflation. This is a 40-year trend that has turned. So the commodities markets are, you're going to want exposure there no matter what, because you're going to have a better chance to keep pace with the debasement of the currency. And I think from that perspective, there's several commodities. I mean, start looking at the weather too. The Fed just came out with a report, San Francisco Fed, talking about, climate change and everything. We can talk about why there's climate change. We can't debate the fact that it's getting warmer generally. And in that case, it's a food issue. And the report that cited a Princeton University report from 2022, I went through it 2.5 hours this morning, 89 pages. It's mind-blowing. I already think food's an issue, and holy mackerel. So you want food items, particularly that are in countries that have weather issues especially currency issues. That's why cocoa was so strong. The Ghanaian SETI had gotten crushed. You have a weather issue with El Nino there, and what happens? Cocoa, record prices. I think coffee's in that camp. I think wheat could be a play here along with soybeans. It's kind of still early. It's early in the U.S. season. You know, the kind of South American crop is kind of done with. It wasn't as great as everyone thought. So you pulled the soybean market all the way back down to below $12, which is exactly what we were looking for. And to that point now, you got to reprice now. If you have any supply side nick in some of these commodities, you don't have margin for error. So it's the supply side, and you've seen that in copper recently. Last time around your show, that was one of our picks, and it's exploded. Why? Because inventories are down. China has taken physical material off the market because they've imported so much for their own strategic reserves, so that, you know, the base metals look good. I mean, aluminum had a run, but you had a ton of selling above $2,700 per ton. I think natural gas is very well positioned here. UNG would be that. We've been long uranium. We talked about that last time. It's made new highs. So, yeah, commodities are a place to be. The newest one we've just added here was coffee last week for a second time. We made money on that already this year. And most recently yesterday in crude oil, and waiting on gasoline to add to it.
So is it as simple as like something like coffee, right? There's going to be steady demand for coffee. People need their coffee. And then if you have the supply chain issues or the supply side issues, that should help drive prices. I mean, I don't want to make it that simple, but is that basically what's going on?
Yeah, it's pretty that simple. And I mean, there is some elasticity in demand in coffee, because that's one thing where maybe you don't go to Starbucks and get your coffee. And that plays out interesting for a hedge fund like play, like being long coffee and short the, you know, high end boutique coffee sellers that are retail. I mean, holy mackerel. I mean, you're stressed out and you're telling me that eating McDonald's, 78% of consumers tell me that's a luxury. Well, I got to believe going to Starbucks and paying $7 for a coffee is luxury before McDonald's. So, yeah, there's demand side issues with some of these commodities, no doubt. Copper would be one of them, too. If the economy gets hit and you have this dynamic in housing, you know, maybe AI and all the build out of, you know, what you need for the energy infrastructure to support the AI build out, which is the demand side story in copper, you know, would be enough to mitigate that. But these markets are definitely markets that are in short supply, and particularly things, you know, in the food group, because you need the replenishment of these crops, a lot of them, and the weather is going to become an increasing issue. I think we've talked a little bit about the science of what's happening on the planet, which is polarization and higher frequencies and vibrations, you know, in the crust of the planet and the ionosphere, and all these things make the weather more turbulent. I mean, we had golf ball size hail here just the other night. We had a power outage here this morning. I wasn't even sure I was going to get back online on time to be on the show.
Where are you, Greg?
I'm in Palm Beach, Florida.
Oh, okay. Because there was big hail back where I'm from in Missouri the other day. I didn't know if you were near there. I guess there's hail. The thing this is kind of off topic, but you mentioned the warmer weather and stuff like that. I also read a report recently that turbulence on airplanes has increased like exponentially because of the weather patterns changing and like that. It kind of scares. I mean, there was a big story a week ago about a plane that went through some severe turbulence and someone actually died from it. Yeah. So you're seeing like, you know, these different effects, I guess, of the climate change, and there's probably ways.
To you know, it's interesting because that really is the big picture science, because that's climate change, but it's above climate change. When you talk about turbulence in the upper atmosphere, this gets directly to the science of what's happening on the planet. And then a brief one, because there's a lot to it and it's tough to really talk about because it kind of make your mind go numb sometimes. But, you know, our solar system doesn't orbit within our spiral arm of the galaxy, and the spiral arm goes around the black hole at the center of the galaxy. So you got multiple orbits going on. In the context of where we are in the Milky Way, we're coming into a place that is highly electrified because there's so much other material. There's so much stars, there's a supernova, there's a pulsar, there's a quasar. I mean, we're in the most volatile area of the Milky Way as we're coming in right now. What happens is you see that all of this light plasma coming from all these directions is hitting the planet. And what it does is it causes the ionosphere to start to vibrate at a higher frequency. So the entire atmosphere is kind of vibrating a little more. So this is definitely a function of the physics of what's happening. I wouldn't say it's climate change in terms of global warming the way people want to say it is, because it's so much bigger than that. You can't change it. The whole green, clean, climate change, EVs, all of this is because we need an engine of economic growth because our debt is huge. And one of the other things that climate change that was in the Fed survey, Fed report that came out yesterday that cites the Princeton 2022 report, I urge everyone to look at this, talks about how how income and wealth will go down with climate change because productivity will decline, particularly in industries like construction and agriculture where people work outdoors. So think about that. You don't even think about things like that could impact, and thus GDP, they're saying, could be as much as 1.8% lower generally at a time when we need GDP growth to be, at par or above to service the debt. So to me, all this clean, green, change the climate, we can't change the climate. It's tens of thousands of years of cycles coming together. This is happening no matter what. We are minuscule compared to all of that.
Yes.
So it's really an economic thing.
So yeah, and it's not about, I guess, because it's polarized and not arguing about the causes of it or where it's coming from, just recognizing what's happening, which is what you're doing, and recognizing, okay, the effects of it. So
what are the stocks to trade? I want to just keep you on that conversation. Like, let's just say, climate change, obviously, I can see it here, where I'm at, warmer weather, you can see the difference here. Yeah. What are the stocks you want to own that are like, one, maybe fighting this, or two, profit from this?
That's a good question. I mean, honestly, to me, it kind of come back to almost the uranium side, because again, you're going to need more energy, and the dynamic around some of the grids or some of the systems we have. When you talk about this movement, as this becomes more intense, because this is a one-way train. You're not reversing this for at a minimum of 500 to 900 years. And of course, who cares about 500 years from now? But that really is the point, is this is a trend that is accelerating and is a major uptrend that's not going to have very shallow corrections, if corrections at all. So when you kind of talk about that, to me, it comes down to energy almost. And if this gets worse and this makes the push for EVs and clean energy even more intense, it leaves nuclear as the most efficient, the cheapest. Sure, it's the riskiest, but guess what? When push comes to shove and people want their energy, and they want all the things that energy brings them, and they want it cheaply at a time when petroleum could be through the roof. And I think that when you look at nuclear, there's something like there was, and I don't know how many are completed now, but at one point there was, just a few months ago, 300 new nuclear reactors either planned, being built, or regulatory stages of getting clearance to build them around the world, including in the US. So to me, uranium is a big play that's longer term and very early stage.
I like that a lot. Well, GregWeldon, I think you're the first guest. Dennis can correct me if I'm wrong, but to talk about our position in the Milky Way and all this stuff. So it was a very fun conversation.
I did not know these things.
Last thing I'll ask, someone in the chat was wondering, do you have any year-end price targets? Like, do you think we're higher or lower than we are now on the S&P come year-end? I guess it's about 6 months away.
I get that a lot, and we don't do that because to me, it's, we manage money, and that's our primary business as a CTA. I don't want to set price targets, because then if it gets there, I feel like maybe I want to liquidate. And I think that right now, and that's actually brings up a really good point for me to make, because what we've seen in cocoa is what you should, and what we've seen even in Bitcoin or Ethereum. These are things that you can apply to every market right now, where you get moves like you never thought you'd see, where the upside is beyond what you ever thought was possible. So those are the kind of things. And when you say, hey, gold at 3,000, well, it wasn't maybe 2 years ago. You said gold at 3,000, you're a gold bug and you're crazy and you're a one-way guy, right? I've been short gold plenty of times in my career. I have no marriage to any position or any bias whatsoever. And one of the things I do every day is try and refute my own thesis. Why am I wrong? What is out there that I'm wrong, right? That's important as all. So, within that context, I think it's really important not to even have price targets, to let it run, because it is so cliche, and yet it is paramount. Let your profits run and make your losses small. And you can't let your profits run if you're getting out at targets that could be, based on things, either theories or algorithms or something that don't apply anymore, because this is a totally new era.
Well, all right, Greg, again, this was a great conversation. We hit on some parts and learned some things that no one else brings us here. It's always a pleasure to catch up with you.
My pleasure.
Hope you enjoy the rest of your day, and let us know next time you go through an 89-page report and send me the Spark notes, because
check out my Twitter. I'm going to actually post some of the charts and some of the findings on Twitter, and it's at Weldon Live on Twitter. So check me out there.
Okay, at Weldon Live. All right, thanks, Greg. Enjoy the rest of your Wednesday. All right, guys, that was GregWeldon. Fantastic conversation. Very interesting there. And guys, what Greg said it himself. He said there's nothing we're doing changing the climate. There's 10,000 years of weather pattern changes. He was just acknowledging that there have been differences. And I don't want to get in the whole argument, but it'd be hard to say that, and Dennis just said it too, like, it's hard to not notice Like we just had a very mild winter in Detroit. It's hard to not notice these changes.
I'm actually enjoying the mild winter.
Yeah, exactly. I can golf more. I can golf.
I'm in the
more.
snow belt, man. Like
Yeah,
I was like, it's actually isn't that bad. I'm getting warm, going outside in a t-shirt and shorts. It's like late April up here in Georgian Bay.
But all right,
but regardless, I mean, Greg makes some fantastic points. Climate change is an issue, all these things. But the points he was making off the hop, is with the consumer being tighter for spending. I mean, that's the point that you started, AB.
Yeah, we were talking about that before you hopped on.
Yeah, I mean, it's a very important point here, and we're seeing complete separation. And people keep talking about the catch-up trade and talking about, well, you're going to have all these other stocks catch up to Nvidia eventually, and you're going to have, you know what? Not if we go into a recession. We go into a recession.
Buying IWM.
It's been terrible, man. The catch-up trade. I have,
but now we're going to finally start. But now
we were talking China last week and how good it was looking. It looks terrible now. Here we are. We even said last week we're going to get a pullback because they always get in China. The pullback happened, but now it's still continuing to pull back. My Baidu, I was up in that thing, straight down $10. I mean, certain sectors, and again, I think it's just China is hated and they're so worried about, geopolitical risk there, everyone. But I mean, it's been technology stocks versus everything else. And, Microsoft, has been unbelievable stocks. It's not, done great over. Well, I guess it's come back too.
It's done well.
It's been the mega cap techs and technology stocks versus everything else. And and not even all technology. Obviously, we look at Cathie Wood, ARKK, near its low for the year. I mean, there's a lot of pockets of weakness here. So what is that telling us? It's telling us, there's this movement to AI, but it's also telling us there's a lot of companies that are struggling here right now, or starting to struggle.
All right, we've got a few minutes left. We got to rapid fire some news headlines because there's some things we have not gotten to today. I'll just go through them real quick. Dick's reported earnings this morning. Strong report, so not seeing the consumer pullback from Dick's yet. EPS came in at $3.30, beats $2.95 estimate. Sales came in at $3.02 billion. Beat the $2.9 billion estimate. Raised guidance, saying people are spending money on workout gear and sneakers. Stock trading higher, 8% there. ANF, Abercrombie and Fitch, your retail darling of the year, also reported strong earnings. Its best Q1 ever. EPS came in at $2.14, beat the $1.73 estimate. Sales came in at $1 billion, beat the $963 million estimate. Raises fiscal year 2024 outlook. Trading higher by about 4.3%. We'll go over to the merger and acquisition space.
Doing all the news at once.
ConocoPhillips, in the chat. Let me know which one you want to stop on, and we can talk more about it in the last 2 minutes. ConocoPhillips announced it is purchasing Marathon Oil, MRO, trading up 11% on the acquisition news. Going back to last night, reverse chronological order, we're going to Robinhood, which announced a stock buyback, brought the stock higher after the close, and has since sold off from those highs, only trading up about 1% after, again, $1 billion share buyback program. I think we did a good job there going through all the headlines.
That was good. I mean, everybody's been wanting the headlines. Let's go to the two retailers and do them together. Abercrombie and Fitch and Dick's obviously reporting. These two stocks have been unbelievable, both making new all-time highs. Actually, Dick's is not. Dick's is higher than this 224. But, getting back to where it was, one thing to consider is I don't know if this is the day to chase. I don't know if this is the day, and I never chase. You know me. If you've been listening to the show for the last 10 years, I'm not a chaser. I don't know if this is the day to chase on these things. And maybe they continue, maybe they go on. I probably just don't trade them. But you got a lot of weakness in a lot of retail stocks. You got a lot of weakness in a lot of other things. And yes, Abercrombie's been unbelievable. Maybe they just bucked the trend. Maybe they're the Nvidia of the retail world. Maybe they really are. But I'm not chasing stocks today. That's, just where I'm at. I think we got to put it in perspective. The conversation we just had with GregWeldon was excellent. If I'm coming out here and buying Abercrombie, Fitch, and Dick's, I'm saying the consumer is going to continue to be strong, and maybe it's the case. But I think the consumer is going to start to weaken. And that's where I'm actually considering raising cash in the non-tech stuff, the value crap. And that's what it's been. Like if your stock's trading with a P of 11 or 12 or less, it's probably a reason for that. It's probably because the business itself is not doing as good as it could be, or maybe consumer is going to slow down, or maybe, just maybe, we're eventually could have that recession that everybody, thought is impossible at this point in time. We're not completely out of the woods. So I
Yeah.
like tech. I'm not selling my Nvidia, but which is crazy. Even people say, "Why? That's the one you sell. That's the one going straight up." Well, that's the one that's held my whole long-term portfolio. I got a lot of crappy stocks in my long-term portfolio. AAL, chat's beating on me. I just bought Baba. Obviously, I'm down $2 in that, or $1.50 or something. Baidu has been bad. There's some crappy ones. You know what? My portfolio is still at all-time highs. You know why? You know why my portfolio, long-term portfolio, is all-time highs? It is. Nvidia, AMD is doing pretty good. The Qualcomm, the AI stuff. The AI stuff is the only reason, because there's a lot of crap in the Bristol Myers I bought. 5 times earnings. How can you go wrong? Keeps going down. Keeps going down.
I don't know if you saw
the value crap has been really crappy.
Deck had another strong day yesterday. So what I was gonna say is I wouldn't call myself a perma bull, but I'm definitely more closer to that than a perma bear. And I wouldn't point to Dick's and Abercrombie's earnings this morning and say, "Oh my God, see, like, look, the consumer's actually really strong. Don't listen to anyone that's saying the economy is weakening." I think you could see a mixture of two effects happening there. That these leading retailer companies, the ones that are hot, are going to show the least weakness when the consumer does pull back, because say you have a budget set aside for clothing, more of that budget's going to go to the companies that people are that are hot right now, and people want to buy stuff from Abercrombie. And then B, I think, it will take some time to see that reflected in companies' earnings. Of course, these earnings are for the previous quarter. So I wouldn't be I wouldn't be surprised if Abercrombie actually makes less money next quarter, saying people pulled back a little bit. So I think you're seeing a mixture of those two effects right now. Not saying that I wouldn't point to those and say, look at how strong the consumer is, because those are the leaders in the space right now, not giving you a look into the overall space.
And you never want to bet against, stocks making new highs, going back to the Abercrombie or back, the Dick's isn't too far. You don't want to bet against the leaders, and they've done everything right. You don't want to bet against good companies. So I'm not saying I'm coming out here and short Abercrombie and Fitch here today, but I think this is a pause. I think we need to look, where the indexes are. S&P is basically at all-time highs. We're 3 points off or 4 points off. QQQs are basically at all-time highs. And we just got to say, we're priced in a lot of good news. We've priced in a lot of good news. And if the news flow starts to get just a little bit uglier, and it did with AAL last night, AAL has nothing to do with the Qs, I'll give you that. But it has to do with the economy. And I think a big reason why you're seeing heavy profit taking here this morning, and you are, is, China was down. Oil's up. But I think this AAL news is a sign that the consumer is just slowing down a bit. And I think it's spooking money managers a bit, because travel's the first shoe to drop. And that shoe dropped last night. So I think a little bit of caution here isn't a bad idea. I have no swing longs on right now, 0 swing longs. I have my core long-term portfolio, and then I'm just day trading. Sometimes when it's going well, I have swing longs, and you're saying maybe we should, because the market's trending higher. I don't like the news flow here right now. I got a little bit of concern that, we're just overbought, definitely overbought in the short term here, even, on certain stocks. Obviously, Nvidia is way overbought. But I think we just got to be somewhat cautious here, putting new capital to work here on this dip this morning, saying, oh, it's coming right back. Maybe we get some follow through. Maybe we don't. Maybe they buy it right back, and the money managers can't help themselves. They're just going to buy stocks. And the stocks I would be buying are tech stocks, probably, if I was buying the dip. But I don't know. There's a tale of two markets still happening here right now, and there's a lot of stocks not participating in the rally.
Yeah, and again, I'm pretty close on the spectrum to perma bull, but I don't disagree that I think, there's definitely some warning signs in the economy. But what I will say to that is, I think once you start seeing that reflected in more and more data, what you're going to have is a lot of people that start saying, oh, this is it, and calling for, say, a 20% correction, a market crash, this or that. My perma bull, lens on that would be the consumer's weakening. That means the Fed's going to cut interest rates. That's going to help X, Y, and Z stocks. So I just try to see I probably am somewhere on the spectrum. No, but all right. That brings us to 9:04 again. Basically the bottom line of the show today, we talked about potentially a weakening consumer and an economy, which would be bad news for a lot of stocks, but maybe wouldn't be cause this whole market crash that some people will call for. Obviously, Nvidia still stealing the show.
It went red. It has given back. It's down $15 since the show started here. So it did go red. It's overbought, folks. It is overbought. I didn't buy any more Nvidia yesterday. I didn't put more capital to work. I do think, you're having that pre-split run. So I kind of wish I would have bought it, a week and a half ago. And on pullbacks, I think you're still going to get this pre-split. The pre-split run has happened. Maybe it happened early here. It's a big move. So I'm playing it cautious here right now with my long-term investing portfolio. Not really buying new positions. I bought some BABA last week. Yes, it's bad, folks. Oh my gosh, everybody wants to call me out on that. Yeah, China has been a laggard trade. And you know what? Probably lose on this because the laggards just continue to lag, and maybe that doesn't change.
All right, guys. Well, that'll be a wrap for today's show. Thank you to everyone who tuned in. Please smash the like if you haven't already. We'll have live trading starting up right now. Tomorrow morning, 8:35, we'll be talking to Raggy Orner. Going to be good to get Raggy back on the show. Again, we will see you guys tomorrow morning, 8 a.m. And happy trading. Try to stay green today.